Hello, folks. Dan Bird here with an update on stocks and the stock market. Today was historically the worst day of the year. So let's take a look at what happened in the market. Hello, folks. Dan Bird here with a midweek update on one rental at a time. Talk about stocks and the stock market. I'm going to share my screen and we'll go through this pretty quickly. First off, as I have been saying for quite a while, today was historically the worst day of the year, going back to 1950. And that's where we are today. So did not disappoint. Now we have to see if we are going to get a recovery or we're going to keep going down. I don't know what's going to happen, but we'll find out here very shortly. But it's interesting to note that we actually did go down, just like this chart says. This is from Stock Traders Almanac, by the way. They do research going back really 100 years, but this data goes back to 1950. So let's take a look at what happened in the market. First, we'll look at the market carpet. Lots of red today. A couple of green. Visa and United Healthcare were green, and Microsoft was green, actually up 3%. Because they reported last night, had good numbers. I'm going to look at all of these here in a second. If I go back, let's go back 5 days and look at the whole week. And there's what we look like for the week. So still lots of red. Google actually went down. They reported as well. Meta reports today. And looks like Meta is down 5.5% right now as well. We'll take a look at those in a second. Let's look at the sector performance as of today. So this is the end of the day today, and the S&P is right here. So everything that outperformed the S&P is above that line, and you can see the ones at the top are all defensive. Utilities, consumer staples, energy, financials, healthcare, mostly defensive sectors. The only actual aggressive sector is technology, which did outperform the S&P, but was still negative. The only two that were positive were definitely defensive sectors, which is utilities and staples. So that's not a good sign. That indicates a market in rotation to the downside, and clearly that's what we've been getting. So let's take a look at, this is the website. The newsletter's here if anybody wants to get the newsletter. I'm going to go right into the front page right here into the S&P chart. And we'll take a look at the S&P. You can see it's right down at the bottom of the channel line. Sold off the whole day all the way to the close. So I'll refresh this and it should be up to date. So right down to the close at the end of today, that indicates or implies that there's more selling to come. The volume was above average, but it's not quite enough, or it's not quite what I would like to see for capitulation. And that's what I'm looking for. I'm looking for some capitulation in the market. What typically happens when you see capitulation is big volume like this, or even higher than that. Opening down the next day, selling off significantly in the morning, and then recovering and coming back in the afternoon, ending with a reversal candle, something like a hammer or something like that. So we'll see. That hasn't happened yet, but we'll see if we can get that. Now we're below the 200-day moving average, we're below the channel line, below all of the moving averages. So things do not look very good. The only one thing I would point out that's a little bit positive is as we are hitting new lows right here on the price, the momentum indicators have not yet made new lows. They still could, but even as this low is printed down here, these have not made new lows, both the RSI as well as the PPO. So both the momentum indicators are still not making new lows, which implies that the selling is running out of steam. So let's take a look at some charts over here. First, I'll take a look at the S&P again. And again, you can see the channel right there below the 200-day moving average, but it's right at a Fibonacci level. A very important key Fibonacci level, in fact, because it is the support going all the way back here to February, which then, or actually was resistance back here. So 1, 2, 3, 4 times, 5 times before it finally broke through that level. And then after it trended up, then this became support. So this is a very important support level right here, 41.75. It might even go a little bit lower than that. If we look at the quad levels and the Fibonacci's, this is a weekly chart. So on a weekly chart, you can see right here how important this line is. This is actually at 41.50, so a little bit lower. But this is the 50% retracement of the bear market of 2022. So that is that line right there. It is also the 75% retracement from the COVID low. From the COVID low to the highs, it's 75% level right there. So another way to think about that is we've come 25% back from the high. So that is a really important level. It's also, as you can see here, an important support level. Was a resistance, and now it is very important support. So 41.50 is a really key level that we need to hold. It could trade below that and then come back. We'll have to see. But if it breaks down below that, and if it breaks down on a candle like we had today, where it closed at the low, then we very well likely might be going to 4,000 after that. Now, remember, after this week, we start the best period, best 3 months of the year starts after this week, sometime next week, going into the beginning of November. So we'll see if this is enough to hold it and if we start to trend back up. Let's also take a look at the VIX. The VIX is elevated. It actually went above 20 today. It ended right about at 20. So it's still up there in that area where there's a lot of volatility. That's the fear index. So there's a lot of fear in the market right now. You can see down here, the S&P is trending lower. Interestingly, the put-call ratio is actually coming down. So fewer people are buying puts, even as the market sells off. So that's interesting. Also, if you take a look at the, well, down here is the 10-year Treasury. It actually came off the 5% level. And then today it started to go back up a little bit, which I think is part of the reason why we had that big sell-off today. So we'll have to watch that and see if that'll go back up to 5 or if it gets rejected and heads back down again. But if you look down here at the percentage of stocks above their 50-day moving average, right now at this level right here, it was at 10%. So what that means is out of 500 stocks that are in the S&P 500, only 50 of them were above their 50-day moving average. Right now, that's at 14.6%, which 14.6 times 500 would be about 73 stocks above their 50-day moving average. Now, those should be stronger stocks, so they might actually lead us out. So there's a way that we can look at those with a scan right here in stock charts. Very simple scan. Just look at the group S&P 500, and let's look at the ones that are above the 50-day moving average. And this is a exponential moving average, so it will be a little different than a simple moving average. So if we run this scan, what we find is there are actually 78 stocks, and these are ranked by technical rank. And you can see Eli Lilly, Palo Alto, Progressive, Netflix is in here. These are all the ones that are still above their 50-day moving average. So these should be strong stocks. Now, if I go back into that scan and I add in, right now these slashes indicate that these lines are hidden. If I add in the ones that are outperforming their industry group, so outperforming their own peers, and outperforming the S&P, both by 7% or more, actually more than 7%. So these are the outperformers. So we'll take this group of about 78 stocks, and we'll see which ones are the outperformers, outperforming the S&P and their own industry group. So if we run that scan, now we've only got 10. So Palo Alto, Progressive, Netflix, it's outperforming both. Allstate, looks pretty good, Raytheon. Now, if we look at these 10 stocks, and I'll move them into a watch list that I can just use to check these out. You can see Allstate right here was positive on the day. But if we look at the charts for each of these, and the thing that I want to focus on are these first two right here. The first one is this stock outperforming the S&P? And if this line is going up, then it is performing. Now, remember the scan I ran, it said outperforming it by at least 7%. So that's the S&P is the red line. The blue line is its own peer industry group. So is Allstate outperforming the other insurance companies in its own industry group? And clearly it is. And then here's the chart up above. Also down here is the industry group itself. Looks pretty good. Is the industry group outperforming its own sector? And it is. And is the industry group, its peer group, outperforming the S&P? In this case, all 5 are outperforming, but the 2 that are most important are these top 2. So let's look at the next one. Cardinal Health, outperforming both of these. The sector is heading down. It's underperforming. Actually, the industry group is heading down. It's underperforming its sector and barely hanging in there with the S&P. The next one is CME Group, outperforming up here. The industry group is definitely not doing well. So even though it's outperforming its industry group, it's outperforming an industry that's not very healthy. The industry is underperforming the financial sector, and it's underperforming the S&P. So while this one as a stock looks good, overall, it might be questionable. Electronic Arts, top 2 look pretty good. Now the industry group just started to underperform its own sector. The sector it's in, by the way, is communication services, which is where the internet stocks are. And it just started to underperform the S&P. So that one is questionable as well. This one here, EQT. First 2 look pretty good. The outperforming its industry group is just barely. Industry looks pretty good, and the other 2 look pretty good as well. Here's Netflix, doing really well against the S&P and its industry group. And again, this is also the communication sector, which is the internet group. Looks the same as the one we just looked at. Energy, this is in conventional electricity. It is a utility stock, outperforming both. And its industry sector down, industry sector and the S&P itself aren't looking that great. How about Palo Alto, outperforming S&P and its industry? Its software group is underperforming, barely hanging in there with its own sector, and it's slightly outperforming the S&P. Progressive, another insurance stock, looks the same as Allstate. So that looks pretty good. Here's Raytheon, a defensive stock, and most of the defensive names have been doing pretty well since the Israeli war started. You can see they've just begun to outperform, even though the industry group itself is still heading lower versus its sector, which is the industrial sector, and versus the S&P is just starting to make some headway. So those are the ones that we want to watch and see if maybe they can be the outperformers or might lead us out. What does the 10-year treasury look like? So it had a little gap up. I showed you that before, and it came up a little bit today. So it's starting to head back towards that 5% level. And the 2-year yield is just sort of hanging out right around that level. Now you notice it's also at 5%. Or right about 5%. So what that is doing is it's bringing up the yield curve. So here's the 10 and 2 yield curve right here. It's still negative, but it's heading towards 0. And once that goes above 0, then the clock starts for a recession in about 6 months. So we'll have to watch that as well. So that's interesting. Let's take a look at the Keltner channels for the S&P. So you can see it is very oversold. It's hitting this very important support level that I pointed out before. Again, there's the positive divergence. So we'll see if that support level can hold. or if it gets down into this next level, 3X level, of very, very oversold, which it could very well do. I'm actually looking for that capitulation that might occur. If we look at breadth analysis, this is very interesting. So you can see clearly as the S&P has been selling off, the NASDAQ versus the S&P has just gone sideways. Growth versus value has actually improved, and it's staying up there. Discretionary versus staples actually has dropped through. So that one is starting to underperform now. That's concerning. And Amazon could be key. So Tesla is a big part of this. Tesla's 20% of this. Amazon is 22%. So if Amazon doesn't hit their earnings as well, this one is going to really start to go down. Mid cap and small cap still are underperforming significantly. Let's take a look at, before I go to this last chart, I want to show you over here. Let's take a look at these relative charts again. Here's the NASDAQ versus the S&P. So NASDAQ down here in pink, and the NDX, which is the NASDAQ 100, so the big cap names in technology. You can see this one is definitely outperforming better than the NASDAQ itself is. And they are still at this point heading up, but they're starting to come down and starting to test their support lines. The next one is the QQs versus the SPY. And again, it has been holding in there, but it's just about to break through that trend line. The one down below, so this one up here is a cap weighted ETF. So you can see the weightings. Apple, Microsoft, Amazon, NVIDIA, and Meta make up the top 5. Whereas the SPY is basically the same except for Google. But down here, these are equal weighted. So while the big cap names have been pushing the market higher, I want to look at also the equal weighted that weights all of these the same. And it is still hanging in there above its trend line. So that means all of the other smaller names are still hanging in there as well. So we'll see, we'll watch that as well. Here's the XLY, and this shows you the Tesla effect. So with Tesla missing their numbers, it dropped through this support line significantly, even though if we look at the equal weighted for both of these, it also dropped through, but not nearly as much as it did up here, because Tesla makes up 20% of this ETF. Now, Amazon makes up 22, so we have to see how Amazon's going to report, which I think is tomorrow. So that is something to watch for. This is the one that's really interesting. This is growth versus value. So even as the market has sold off, you can see the SPY and the triple Qs down here, so the S&P and the NASDAQ, and especially the Russell 2000 down below. All three of those have broken through their trend lines. However, growth is still above its trend line. So what that's telling you is that big institutional traders are rotating out of value and into growth, even as the market continues to sell off. So they are positioning themselves for a potential rally at the end of the year. Remember, next week starts the best 3 months of the year. So we'll have to watch this, but this is really interesting. This is the opposite of what happened in December of 21. This line was going down significantly in December, even as the market was hitting all-time highs in the month of December. So it was signaling to us that institutional traders were moving out of growth, moving into value, preparing for a bear market that came in 2022. This is the opposite of what happened back then. So important to watch that. Let's take a look at a couple of these names down here. Here's Google. Google missed. So you can see right there is the reason why that the software sector, as well as communication services, which is where the internet group is, why that is heading down significantly. Meta, which reported tonight. In fact, let's see what Meta is doing. I don't know what their numbers were, but we can take a look at it in real time. Oh, it looks like they actually had some good numbers. So Meta is up 2 3/4%, up $8 after hours. So that's a good sign. That may mean that that sector and that industry group might start to come back. So that's good for Meta. So this will probably be back up. What did it say? 307, be back up to its 21-day moving average. Microsoft had good numbers. You can see right there, went up and pulled the software sector up with it. Netflix also had good numbers and it's hanging in there. It's actually starting to move up. So Netflix had good numbers, gapped up, but it did not come back down. It did not give back any of those gains. So that's a good sign. This is also the communication sector. NVIDIA, which reports third week of November, had a sell-off today, but it's still above this very important support level of 400. If it drops through that, it could very quickly close this gap back down to 325 or 300 in that area. So that's one to watch towards the end of the month. Tesla, of course, missed their number. They're hanging in near the bottom, but this could be just a prelude to more selling. This is a point where it consolidates. The consolidation theory typically says that it will go the same distance down. So 250 to 210, so another 40 bucks down, which would put it at around 170 down here. So we'll see what happens. And Apple still not looking too good. It's hanging out at its 200-day moving average. And AMD also, along with NVIDIA, sold off today below its 200-day moving average right now, sitting right at a support level at $95. So it will have to see what happens. And if the market continues going lower, that one probably will go lower as well. So the last one I want to show today is this one, the McClellan oscillator. This basically looks at the advanced decline lines of the NASDAQ. So the number of stocks that are advancing versus the number of stocks that are declining. And if this line is below 0, that simply means that there are more decliners than there are advancers. And you can see I highlighted where this went above and below 0 to show the bullish and the bearish areas that pretty much fairly well coincide with the index itself. This is the NASDAQ 100, by the way, down here. Even though this is the NASDAQ, I use the NASDAQ 100 to show down here. So the interesting thing to me is that even as the NDX has been selling off, making lower lows, this advanced decline line has been making higher lows. So that, again, is a positive divergence and may indicate that the market is starting to run out of steam for this sell-off right here. We're going to see next week. The rest of this week, we've got 2 more days. It's still one of the worst weeks of the year, today being the worst day of the week, but we'll see what happens tomorrow. I'd love to see a big sell-off and then have it come back in the afternoon, but no telling if that will happen. So anyway, thanks for listening. That's my midweek update. Keep an eye on things tomorrow. IBD Sales still says market in correction, obviously. So hope everyone's doing well. Hope you're staying safe and keep your stops on. Hopefully you've moved to cash and we're waiting for the market to start to turn around. Thank you very much and have a great day.